Welcome to This Explainer. If you've been looking at the headlines lately and feeling like there's a complete disconnect between what the financial news says and what you actually feel in your wallet, well, you are definitely not alone. Today, we're using data from 3 expert sources to unpack the incredibly confusing reality of our current economy. We're going to break down the complex forces at play right now, looking closely at how global events, government policies, and shifting markets are creating a deeply unusual economic landscape. Okay, let's just dive right into this massive paradox right off the bat. On one side, you got the NASDAQ and the S&P 500 literally touching all-time highs, right? Mostly riding on incredibly strong earnings from just a handful of massive tech companies. But then, on the flip side, the widely followed University of Michigan Consumer Sentiment Report just showed a drop of nearly 8%, hitting a record low. So how on earth is Wall Street throwing a party while Main Street is feeling so incredibly pessimistic? To demystify what's actually happening here, we've broken this explainer into 5 quick parts. The Great Economic Paradox, the Energy Chain Reaction, the Federal Reserve's Dilemma, tariffs and global forces, and finally, preparing for the future. All right, Section 1, the Great Economic Paradox. Let's zoom out for a second to some macro data from Wharton professor Mohammed El-Arian. This really shows why average numbers can kind of mask a very painful reality. A recent Labor Department report showed 115,000 jobs added in April, easily beating expectations, with unemployment sitting steady at 4.3%. Now, on paper, that sounds absolutely fantastic. It shows undeniable resilience despite all the global shocks. But as Professor El-Arian points out, just looking at that overall average right now is highly, highly deceiving. Because right beneath those strong averages, the real economic experience is drastically splitting. While white and Asian unemployment rates are either holding steady or even improving, Black unemployment is actually worsening, and it's now twice as high as white unemployment. So the paradox makes a lot more sense when you realize lower-income households and minority groups are facing this intense mounting pressure, while higher-income folks are mostly insulated. Wall Street is happily trading on those insulated averages, but Main Street actually feels the divergence. Which brings us to Section 2, the Energy Chain Reaction. Now, a lot of this micro-level consumer pain starts with energy. It's basically the first domino to fall for all our other expenses. According to FinThrive, the average gallon of gas recently hit $4.44. Just a year ago, it was $3.17. That is a massive 40% jump in just 12 months. And listen, it's not just annoying when you commute. It literally functions as an invisible tax on your spending power. It's money vanishing from your budget that doesn't come back as roads or schools. But honestly, what you see at the gas station is just the tip of the iceberg. Since energy touches literally everything, the fallout is brutal for businesses running on thin margins. A stark example of this, the 17,000 Spirit Airlines jobs that practically vanished overnight. Yes, they had some underlying financial struggles, but the sudden, sharp surge in jet fuel prices was the final blow they simply couldn't absorb. And that ripples out, right? It affects the contractors cleaning the planes, the snack vendors, and everyday travelers who are suddenly looking at $600 replacement flights instead of $150 ones. This domino effect absolutely hammers the broader economy. Specifically, look at diesel fuel, which has spiked an incredible 59%. A spike in diesel fuel today essentially guarantees a spike in your food costs 3 to 6 months from now. Why? Well, because the tractor harvesting your food runs on diesel. The natural gas used to make the fertilizer cost more. The delivery trucks run on diesel. Economists call this lag second-round inflation. Basically, the pain you feel at the pump today is just the warning shot for the grocery aisle tomorrow. Moving on to Section 3, the Federal Reserve's Dilemma. So with energy squeezing all our budgets, you're probably wondering, why can't the central bank just fix this? Well, Harvard economist Jason Furman identifies 3 root causes for this inflation that have severely complicated their job. First, the enormous COVID-19 fiscal response. All those checks and forgivable loans flooded households with money when the economy simply couldn't produce goods fast enough. Second, massive global supply shocks, specifically from the invasion of Ukraine messing with oil and food markets. And third, the Federal Reserve simply took too long to respond to the initial inflation data. And because of all these intersecting shocks, the Fed is trapped in a vicious catch-22 right now. If they cut interest rates to stimulate the economy and help struggling families afford their mortgages and car loans, they risk pouring fuel on the fire and making inflation even worse. But if they raise rates to fight those high prices, they risk crushing businesses, triggering layoffs, and just flat out killing economic growth. They are completely stuck in the middle. To make matters more difficult, Professor L-Arian notes that the internal dynamics at the Fed are adding a whole other layer of complexity. Incoming Fed President Kevin Warsh is going to be stepping into a highly divided board where both inflation and employment are massive concerns. Plus, in a super unusual move, Jerome Powell is stepping down as chair, but actually staying on the board. This complicated leadership transition, paired with all the conflicting data, means we likely aren't going to see those interest rate cuts you want for your credit card debt until well into next year. Section 4. Tariffs and Global Forces. Stepping away from the Fed for a second, we really have to impartially examine global trade. Tariffs get thrown around constantly in the political arena as this magic bullet to protect domestic jobs. But analyzing the mechanics neutrally, Jason Furman notes that mathematically, tariffs consistently just end up raising prices for consumers. Plus, they tend to shift countries away from their core strengths. If you force a country to allocate resources to something it doesn't produce efficiently, you're just pulling labor away from the highly innovative, higher-paying industries where it actually excels naturally. To put this into a crazy global perspective, China actually lost 30 million manufacturing jobs between 2012 and 2020. Think about that. 30 million. That is more than double the total number of manufacturing jobs that even exist in the US today. That staggering number proves that tariffs alone simply cannot stop the massive global shifts in labor and automation that are reducing manufacturing employment all over the world. But hey, it isn't all bad news when we look at global forces. Furman points out that while a $100 barrel of oil hurts right now, we're actually way more insulated from global energy shocks than we were back during the devastating crises of the 1970s. Today, our economy is only 1/3 as reliant on oil, mostly because we've shifted to a service-based economy. Consumers spend half as much of their budgets on gas as they did 50 years ago. And absolutely crucially, we've transformed from being a massive net oil importer to a net oil exporter. Which brings us to Section 5, Preparing for the Future. So, what can you actually do right now to navigate these conflicting forces and protect your own finances? FinThrive offers 4 super practical, proactive steps to get ahead of this lagging inflation and high interest rates. First, if you can swing it, stock up on pantry staples right now before that second-round food inflation hits your grocery store. Second, urgently revisit any variable rate debt like your credit cards because those rates are staying elevated. Third, watch your investment exposure. Things like energy stocks can sometimes act as a hedge during inflation. And fourth, stay informed, but don't panic. Panic leads to terrible financial decisions, but understanding these chain reactions, that keeps you ahead of the curve. And we really should take a breath here. As Jason Furman perfectly captures, the American economy is fundamentally very resilient. It's so important to look past these immediate day-to-day cyclical risks, like fluctuations in tariff news or daily oil prices, and focus on the long-term productivity and underlying strength of the system. We've absorbed massive shocks before, and we can continue forward. Ultimately, though, as Furman warns, the absolute most misunderstood force shaping our future productivity isn't inflation, it isn't interest rates, and it's not tariffs. It's artificial intelligence. The true unknown is exactly how this single, massively disruptive technology is going to rewrite the rules of our entire economy. Whether you think it's going to be a perfect utopia or a complete disaster, you're probably wrong because the sheer scale of its uncertainty demands some serious humility. So the real question we have to leave you with today is, as the economic rules are literally being rewritten before our eyes, are we truly prepared for what comes next? Thanks for tuning into this explainer. Keep learning, and we'll catch you next time.